Good afternoon. Good afternoon, everyone. This is Bagadon at Stock Market Caddy. It is a Tuesday, December 7th at about 3 p.m. And we wanted to take this opportunity as a teaching moment to explain to our annual members, our monthly members, and even post this on YouTube to give you an idea of the extent, the approach of some of our trading and some of the tools that we use. You're looking at the TradeStation product called Option Pro, which is superb, and you're looking at a position right here that we placed back some time ago, and we're going to highlight this. Actually going to open it up. It was a put option that we bought some weeks ago before the market turned down, and then on Friday of last week we matched that put that we bought by selling a put when the market was very, very fearful on Friday afternoon. So I want to show you what the trade looks like, and then I'm going to describe for educational purposes what it looks like on a graph and why we did what we did. So let me show you. Okay, so this is right now it's a vertical put spread, and I'm going to break this apart. I'm going to reset the position, and so now you can see the two legs as we put this on. This was the first leg that we put on. We bought a put, and we did this probably about 45 days ago. We only have 31 days left, which is still quite a bit of time. We bought a put that expires on January 7th on the NDX 100, and we bought it with a strike of 16,600, and it was a put. It's a bet that prices were going to fall. 31 days are left, still more than half of our time, so we're fine. And the cost of this put, it cost us $45,000. Okay, so one could be a speculator, one could be looking to hedge a long-only portfolio, but that's up to each individual person. At that time, when we placed this, our maximum risk, one way to look at this, our maximum risk would have been the cost of the put. And as you saw last week, the market had turned down. Now, this put had been worth as much as, I'm going to say close to $60,000, 60 some odd thousand. Now, we could have closed it and pocketed that money. Right now, it's only worth $8,000 more than what we paid. So if we went into the market, we bought the put. If we wanted to sell the put can be sold for an $8,000 profit. And you might be thinking, well, man, Don, you blew it. You should have taken your money. Well, maybe I should have, but what we did do, and we were aware of what you were aware of, that the market was likely to bounce. So what we did on Friday, we went to the same strike, January 7th. This time we went to a put, and we're going to draw this out for you at 15,000. Okay, so just 31 days out. And in this instance, what we did was to sell a put, which obligates us to buy if the price went below 15,000. The price of the NDX has actually bounced. Now, when we did this, the market was trading at 15,500. So we received a credit of $37,750. Thereby reducing our maximum risk. Here we paid, here we received a credit. So our net cost was $7,300. So we reduced that cost. Because the market bounced, they're not fearful anymore. Where we sold a put, we could now buy this put to close for a fraction of the cost and actually pocket some $25,000. Now, just disregard that. I'm actually going to close that. That's a little trade going off elsewhere. And let's bring this up here. I'm sorry. There we go. So that's what we did. And if I was to take this and just click on it and drop it in there, it actually puts the two of them together, and it shows me when I put the two of these legs of the puts together, it shows me that my total cost of them was $7,300. And if I close them both right now, I'd still make 34 grand. Not the 70 or the 60 some odd that I had in my pocket last week. But this is now what I want to do. I think the market has bounced too far, too fast. I think we're headed back down. That's on my original bet or trade. So I'm going to come in here, if you don't mind. I'm going to highlight this. I'm going to reset the position. And what I want to do is this put right here, I want to close it. And I'm going to close that position. We're going to put it in as a market. And we're going to place the order. And we just closed that put, and we just put about 25 grand in our pocket. And so now I have still my original put. I still have that much money at risk. Of course, I just put about 25 grand in our pocket. It's still up about 9,000. And if the market turns down again, this very well might run up another 50, 60. It might even run up 100 grand if the market really takes a dumper between now and when? January 7th. Now, how and why did we come to do this? Let me show you. Okay, one of the things that we know is that when you have price here, we're going to call that the mean, a 20-day average mean. And when you move out here, when price moves out here above the mean or below the mean, we're going to say it's a 20-day average mean. That's the middle. When you have price out here or under here, the likelihood that price is going to move back toward the mean is about 95%. Not 100%. Nothing ever is 100%. But it is likely to move back toward the mean. So what we did when the market, and so we're going to represent this, we're going to kind of draw this in freehand. When price moves out here, this is supposed to be even, that's supposed to be the mean. When price is out here, the likelihood that it's going to move back toward the mean is about 95%. Not a guarantee, nothing is, nothing ever is. And when price is under here, under the mean, it's likely to the tune of some 95% to move back toward the mean. So when we were trading the NDX a couple of weeks ago, where was price in relation to the mean? It was way out here. We were trading at 16,600. That's where the NDX was. That is when we bought our put for January 7th. We were playing the likelihood, the probability that price was going to move back toward the mean. And it did move back toward the mean. In fact, it went all the way down into here. This area out here was, guess what? Was 15,000. Somewhere around here, in rough numbers, give or take. But price had moved way down in here. So what we did was we bought this put, and as long as price moved in that direction, we would make money. Of course, if price beat the statistics and continued up higher, then we wouldn't look so good. Our put would have gone down in value. But when they panicked, sold, and got down in here, what we did was we bought this put, we sold this put. So over here, this one cost us 48,000. Try to do this, hard to write with a mouse. 48K. Over here, when price was down here on Friday, down around 15.5, we sold this put and we received a credit of 37 point, I think it was 5, right? Give it back, take $1,000. So now my maximum risk, whoops, I didn't mean to do that, but my maximum risk is the difference between the two, roughly about 7 grand. So, and we did it when price was at 15.5. So if price had continued to fall, this would have, I would have profited all the way to 15,000. This would have cut off my profits if we went to 10,000. That's in essence what it would have done. But today, I did that on Friday, 37. What did price do? It didn't continue to fall. It bounced back toward the mean. So what did I just do? I just closed that one and I put $25,000 in my pocket. I still have this one and we're someplace in the middle. We're at about 16.2. So now if price continues to fall, I stand to pick up maybe another 100,000. Maybe if I even go below that, I can even pick up more. But by pocketing that money, I've reduced the cost of my trade, but I still got 31 days. When I start to lose, if I start to lose more than half of my premium or half of my time, I become concerned. How did I know where price was? How did I know where it was? Well, let me show you. This is our tool that we call the SMC driving range for active traders or timeliness. Here is the NASDAQ. Here is the NQ. This is the product that we bought a put on. And you can see it's trading at 16,282. Where is the mean? 16,280. That is the mean. So when it was way, way over here, that's when we bought the put. And then on Friday, where was it? It was way, way down over here at around 15.5. And that's when we sold the put. Now we just come bouncing back to the mean. That's where I close this put. I'm going to keep an eye on it very closely over the next couple of days. Maybe I close this put. Maybe I roll it out another 30 days. I think it's quite likely we're going to have another leg back down, and this one might be the big one. And if it is, I still got a very profitable put in position, and I have plenty of time. I'm Bagadon at Stock Market Caddy. We are not a broker. I am not a financial advisor. We don't make specific recommendations to buy or sell a thing. We share our perspective and our tools with other like-minded, serious-minded, mature traders. It is just an opportunity. We are a mentoring site, and we think that we can save you time and money. We hope to give you some ideas on how one can go about managing risk and mitigating risk, either for speculation or for hedging purposes. Now, these were large sums. One could scale this sort of approach down. But I can't show it, I think, any more clearly, and I hope you've enjoyed this. If you have, be sure to push the like button, be sure to follow. It's free to follow on YouTube or on StockTwits, and we wish everyone the best. Be sure to visit stockmarketcaddy.com, and you're more than welcome to give me a call at 813-758-8263. Good luck, everybody.